The people who are thinking that we've seen the worst of inflation are wrong. All we've seen is a small down payment on what's coming.
Inflation at the grocery store and the gas pump. It seems to be affecting Americans at every turn. Today, Peter Schiff, a renowned investor and financial commentator, gives his insight on inflation. His views are quite alarming and should cause us to take note of the risks we face as consumers and investors.
We're going to see much higher prices in the months and years ahead. The Fed has barely made any progress in the war against inflation. In fact, it may have even gone backwards. Yes, we've had some temporary relief due to the initial pullback in commodity prices, but once commodity prices bottom out, they're going to be headed for new highs, and we're going to see just how much ground we've actually lost, because the Fed hasn't even come close to raising interest rates high enough to restore inflation to 2%, nor have we gotten the required cooperation from the U.S. government. Because instead of reducing government spending and adopting a contractionary fiscal policy to help bring down inflation, deficit spending is rising despite Biden's lies to the contrary that he is reducing deficits. Deficits are increasing, and that is an expansionary fiscal policy that is adding fuel to the inflation fire.
Inflation has had serious impacts on Americans. The gradual increase in prices for goods and services has eroded purchasing power. More and more Americans are finding it difficult to make ends meet.
We don't have a strong labor market. We have a weak labor market. If you're in a labor market where your wages are not keeping pace with inflation, that has to be characterized as a weak labor market. How can anybody say a labor market is strong when workers can't demand that their pay go up equal to inflation? In fact, if it really was a strong labor market, you would expect that workers had the upper hand and they could get real wage increases. They could force their employers to give them a raise that actually exceeds the cost of living. That would be a strong labor market. But if workers have no choice but to accept real pay cuts because the only raise they can get doesn't even come close to the increase in the cost of living, that is a weak labor market, and that's what we have. We got data from the Federal Reserve that shows that in the fourth quarter of 2022, household debt hit a new all-time record high of $16.9 trillion. Households took on another $394 billion of debt during the quarter. That's a 2.4% increase. Even worse, credit card debt rose 6.6% to $986 billion during the quarter. That is the fastest quarterly growth in credit card debt ever since the Federal Reserve started measuring it back in 1999. And year over year, credit card debt soared by 15.2%. That's despite the fact that Americans were flush with stimulus money. They blew through their stimulus and they had to run up their credit card balances to afford to pay the higher prices that were resulting from inflation. Think about that. We almost have $1 trillion in credit card debt.
Peter Schiff believes that the U.S. Federal Reserve's practice of printing too much money is the primary cause of inflation, leading to higher prices and a decrease in the value of the U.S. dollar. Schiff warns that these effects can have disastrous long-term consequences for the economy and investors.
Credit is still cheap. Despite these rate hikes, credit is still plentiful, and the Fed needs to do something to tighten it up by raising interest rates far more substantially. Maybe by raising the reserve requirements, requiring banks to keep more of their deposits on reserve so there's less available to loan out to consumers to buy things using credit. That's what the Fed would need to be doing if it was truly serious about fighting inflation. But it's not serious because it knows if it got serious on fighting inflation, it would crash the economy. In fact, it would probably cause a financial crisis. That's why it's not serious, but it can never admit that. So it has to pretend that it's trying to fight inflation, even though it's still pursuing policies that are fueling the fire.
Schiff's perspective on inflation has been widely discussed in the media, and many experts share his concerns. He warns that the Fed's policies are leading us into an inflationary spiral that will be difficult to stop.
I want to switch gears a little bit now and put into some historical perspective just how difficult it's going to be to put the inflation genie back in the bottle, because everybody seems to have lost track of what's happened in the past. They think it's going to be very easy for the Fed to get inflation back down to 2%. In fact, they think that a Fed funds rate of about 5% is all that needs to happen. And in fact, after inflation goes right back down to 2%, everybody assumes that the Fed could just lower interest rates, that they don't have to stay at 5%, that as soon as the Fed achieves its objective of returning inflation to 2%, that it doesn't have to leave interest rates all the way up at 5%, that it can move them down. But if you look back at the 1970s experience, it shows that putting the inflation genie back in the bottle is a lot more difficult than people believe. That's why we actually have the expression that you don't let the inflation genie out of the bottle. If it really was so simple to put the inflation genie back in the bottle, we wouldn't have that expression. The reason we have it is because it's difficult, and that's exactly what the 1970s experience proved. Now, I've already mentioned that it took Paul Volcker 6 years to get the inflation rate back down to 2%, and then the Fed didn't even achieve that feat again for another 12 years. Powell seems to believe that he could bring inflation back down to 2% and keep it there indefinitely. Well, what did Paul Volcker have to do with interest rates to get inflation back down to 2% after fighting it for 6 years? Remember, Powell has only been fighting inflation for 1 year.
Inflation poses a major risk to all of us financially. It can make it harder to save and invest our money, and has led to significant increases of cost of living.
Easy. So it's pretty clear if you look at how high interest rates had to rise and how long they had to stay there during the 1980s to eventually bring inflation back down to 2%, we've barely started. A 4.6% Fed funds rate is nothing. We need to see a Fed funds rate double or triple where we are right now. The problem is the economy can't handle it the way it was able to handle it back then, because we didn't have anywhere near the debt. The national debt didn't even hit $1 trillion until 1980. It's close to $32 trillion now. So the economy can't withstand an inflation fight. The fight itself would kill the economy because it's a phony economy. It's a bubble, and it would produce a worse financial crisis than the one that we had in 2008. Which is why the Fed is not going to be able to succeed in fighting inflation. It's impossible.
Schiff suggests that the problem is American debt, and one of the indicators of that problem is consumer debt. Do you think he has it right? What have you done to beat inflation? Join the conversation in the comments below and tell us how you've been dealing with inflation. Thank you so much for watching. If you're looking for more content on the economy, finance, and inflation, consider subscribing and hit the notification bell for more updates on all our latest content.